Hello everybody, welcome to the channel. In today's video, I'm going to give you my top 5 dividend stocks for 2023. These 5 dividend stocks are going to pay you dividend through 2023 and beyond, despite the fact that we may have a recession possible in 2023. So if you like this video, go ahead and give it a like. If you have any questions or concerns, or maybe even have your own dividend stocks that you think that would possibly do better than the ones I'm going to give you, let's talk about it in the comment section below. And just to let you guys know, we are a new channel. We're trying to grow and hopefully someday soon get to 100 subscribers. So go ahead and subscribe to the channel, as this does help us out. I got my top 5 dividend stocks. And if you stay to the end of the video, I'm also going to give you a 6th stock that you can possibly invest in. All right. So thank you for watching. Now let's get into it. All right. So first off, we have PepsiCo. Pepsi, one of the largest beverage makers in the world, second to only Coke. They are a huge company. They're one of the top beverage makers. They have a ton of beverages. Many of these products that you guys have drank on a day-to-day basis, they own so many beverages. It's ridiculous. Diversifying their business outside of just a soda brand, but even diversifying it even more. What a lot of people do not know is Pepsi is also one of the largest snack makers. They own a ton of snacks out there, including well-known brands like Quaker Oats. You got Doritos, you got Cheetos. So they are well diversified business. And this is one of the key reasons why I kind of like them better than Coke, because they are more diversified and have a less chance of them cutting that dividend from being so diversified. Now, when it comes to their dividend, they don't have the highest starting yield. They're at 2.45%. With that, you are getting 50 years of dividend growth. So we're looking at a dividend aristocrats, one that has been going on for a very long time. They constantly focus on continuously paying that dividend and have not cut it in over 50 years, which means they went through the 07, 08, 09 recession and still kept that dividend going. So we got a company that is very dedicated to paying that dividend. And then something that I like a lot from them is the payout ratio. When it comes to dividend companies, especially during a time when we could potentially have a recession, because what usually comes with a recession is dividend cuts. Usually a lot of companies like to cut their dividend. Something to pay attention to make sure that dividend is secure is that payout ratio. Currently, Pepsi is at a 67% payout ratio, which is high, but is lower than the 70% that I like. For me, I look for companies that are under 70% because that kind of shows you that even if that company's earnings drop, they can still pay that dividend. And under 70%, I do like that. They're a dividend aristocrat. They've been doing this for over 50 years of growth, and they are one of the most well-known brands in the world that is very diversified. So Pepsi is a company that I like tremendously. One of the best run companies in the world. My top 5 dividend stocks. Now let's get to the next one. All right, next up we have AbbVie. AbbVie is one of the largest pharmaceutical companies in the world. I'm pretty sure some of you may have heard about it, some of you may not, but they are one of the largest. When it comes to their products, they own a wide range of products that a lot of people use. Their biggest one being the Humira drug. The Humira drug is a drug that's been around for a very long time. I'm pretty sure you guys have seen commercials on it. I know I've seen commercials on it throughout the years. So very well-known brand, very well-run company. Then to top it off, I don't know if you guys know, but if you do, they did do a purchase of Allergen a couple of years ago, back in like 2020. 2020. They did do that purchase. Cost them around $63 billion. So they did purchase Allergen, and what that gave them is Botox. So they are the company that owns Botox as well. So that's another leading brand that helped diversify their business and help them grow. And one of the things that also helps them support the dividend. When it comes to the dividend, they have a fantastic starting yield of a 3.5%, a very good starting yield, higher than most companies out there. They haven't been growing it as long as we would like, as they've only been growing it for about 9 years. They're not a dividend aristocrat, but they've been growing it at a very good rate. We're looking at a company with a 5-year growth rate of 17%. Anything over 10% is a win in my book. You actually look for companies that are growing their dividend over 10%, because what that shows is it shows that they're very dedicated to growing it. It shows that they're going to be somewhat aggressive with growing it. So we got a 5-year growth rate of over 17%. We got a dividend starting yield of 3.5%. Fantastic. And when you look at it, when you look at the payout ratio, you can see that it's at 42%, lower than the 70% that we like. So we have another company that is growing its business, that is growing its dividend, and still has a very good payout ratio. They can continue to support that dividend without it interfering with their business too much. So that is something that we do look for. And then in total, when you look at the healthcare sector have done tremendous. The healthcare sector for the year for 2022 as one of the best growing sectors out there. We got probably one of the only sectors other than like energy that actually grew in 2022. When you look at the S&P that was down over 20%, and you look at the NASDAQ that was down over 30%, you got companies like AbbVie that was up over 19%. So we got a company that grew during the downturn in the market of 2022. So this is something that I really do like. It kind of helps us and shows us that this company can go through downturns and still grow, right? With a growing stock price, a growing dividend, and a very low payout ratio, we can see this company doing tremendously in the future. And that's one of the reasons why it is one of my top 5 dividend stocks for 2023 and beyond. That was number 2. Now let's get into number 3. Speaking of pharmaceuticals, we have one of the largest pharmacy stores in the world, one of the best run businesses in Walgreens Boots Alliance. Walgreens, which sells a wide range of products. You can get all type of things from there, but one of the key things that they sell is drugs or pharmacy products. So they are known for their pharmacy products and their pharmacy brands, one of the largest out there. They're the number 2 player in the field right next to CVS, but I do like Walgreens a little bit better because of their dividend. We have a company that has a very good starting yield at 5.2%, one of the best starting yields out there in the market, one of the companies that most dividend investors have in their portfolios, and is a company that's been having a very good run. When it comes to their dividend growth, you can see that they've been growing it for over 30 years. Over 30 years of dividend growth. They've been growing it consistently over the last 30 years. They have been through recessions. So when it comes to the point, if we have a recession in 2023, this is a reliable company that most investors do own, specifically if they are dividend investors. And then one of the best parts about this dividend company is their payout ratio. We like companies that have a payout ratio lower than 70%, and you have Walgreens that has a 42% payout ratio. So they are in a position where they can well support this dividend, despite the fact that we may come into a recession and their business may not grow as it usually has. So we have a very good starting yield, we have a very good payout ratio, and we have a long history of supporting this dividend. So Walgreens is a company, like I said before, that most dividend investors have in their portfolio, and it is a tremendously run company, one of the best out there. When you look at their business, when you look at what they do, you can see why this is a company that really, even if we go into a recession, there is still going to be a company that's continuously going to make money, that's going to continuously grow even in a recession because of the fact of their pharmacy, right? When you go to pick up your AbbVie products in your Humira or your Botox, right? When you go to pick up any kind of medicine, you're usually going to pick it up at a company like Walgreens, right? So it's a very good business. It is a very good dividend companies and one of my top 5 dividend companies for 2023 and beyond. We still got 2 more companies left. Now let's get into number 4. All right, so next up we have VEIS Properties. Some of you guys may not have heard of this company before, but they are a real estate investment trust. They are a real estate investment trust that has a really neat model. what they focus on is the experience. They focus on and buying properties that give you an experience, and not really like regular homes or businesses, but something that gives you an experience. Example of this is they own many properties on the Las Vegas Strip. They are one of the largest landowners in Las Vegas. They own the land that Caesar's Palace is on. They own the land that the Venetian is on. They also own the land that MGM Grand is on, as they recently just did a buyout of MGM Grand properties for about $5 billion. They did buy the land recently in the last few months that MGM Grand is on, as well as Mandalay Bay. So this is a company that I like a lot. This is one of the best companies out there when it comes to dividend. When you look at their dividend, you can see why. They start off with a 4.9% yield, a very high yield to start you off. Now, some people may be looking at the payout ratio and say, oh my God, what is going on? But something to keep in mind is this is a REIT. This is a real estate investment trust. Real estate investment trusts, or REITs more like it, have to give out at least 90% of their profit. So they have to give that away, which most of them give it out via dividend. So when you look at REITs, you will always see they will always be at least 90% and above. So REITs are always going to have a very high payout ratio, and it is normal for a REIT to go above 100%. Now, something to keep in mind is this payout ratio is a little bit higher than normal because of the recent purchase of MGM Grand. So they recently just bought that. So they did have to borrow money in order to do that. But this kind of helps them support that dividend. And even right after they bought MGM Grand, they announced an increase to the dividend. So we have a company that has a very, very good starting yield. We have a company that has really focused on paying that dividend consecutively. They recently just got into the S&P 500, and they're actually doing tremendously for 2020. As you can see, once again, how the stock market had a rough year with the S&P down 20%. We got the NASDAQ down 30%. VICI actually went above this, right? VICI actually outperformed both of them despite all the turbulence that happened in 2022, I'm sorry. So we got a company that has a really good starting yield, that is dedicated to paying that dividend. And then the thing is, what makes them recession proof, in my opinion, is they focus on brands or land that focus on the experience, right? When we talk about the experience, they own properties or land that really can't really go out of business, right? So when you look at Caesar's Palace, they can't really go out of business, right? Where if you were to buy a land of a shopping mall, right, that land or that mall may go out of business. A lot of those companies might leave and might go away. Where you look at the Strip, Caesar's Palace really isn't going anywhere. Now, I'm not saying it can't go anywhere, but it's very unlikely that it will go anywhere, right? MGM Grand isn't really going out of business, right? The Venetian isn't really going out of business. Mandalay Bay isn't really going out of businesses. So these business aren't really going anywhere, and they can continue collecting that rent from these companies, and they collect a set amount that doesn't really affect how that business is doing. So if Caesar's Palace is paying them $1,000 a month, they're going to continuously, obviously they're going to pay them more than $1,000. But if Caesar's Palace is paying them $1,000 a month, they're always going to get that $1,000 despite how the business is doing. Despite if Caesar's Palace business is going up or down, they're going to continuously collect that money. So that is something to keep in mind on why they have a very durable business. And I do like their business model a lot, focusing on the experience versus just owning simple property, right? So VICI is a company that I do like a lot. I think they're a well-run company. I think they have a very good business model, and it's actually one of my largest investments in my personal stock. Do your own research, and if you guys want me to do a video on them or any company in this video, please let me know in the comments below. But VICI is a company that I do like. I personally own it in my portfolio. That is one of my top 5 dividend stocks for 2023 and beyond. Now we got one more stock left, and if you stay after that one, we do got a bonus stock after that. All right, now let's get into it. Last and certainly not least, we have at&t. at&t, one of the most well-known brands across the world. I'm pretty sure most of you guys have used their services, as they're one of the largest companies when it comes to cell phone data, as well as internet providers in the world. They have been around for decades, one of the oldest companies when it comes to their field, as they at one point were considered a monopoly. I don't know if many of you guys know that, but at one point were considered a monopoly and had to be broken up. But we do got at&t. When it comes to their dividend, it is a funky of a history, as recently they did just cut their dividend. The reason behind this is because they did spin off their Warner Media. They did own Warner Media, purchasing a few years ago. They recently just spun it off and kind of grouped it with Discovery to create the new company, which is Warner Bros. Discovery. Now, because of this, they did cut their dividend to lower it so they can help pay down some of their debt, as they're really focused on paying their debt down. But because of this, it did lower their dividend, and it did also pay off their debt. So that was one of the things they were focused on. When you look at at&t and you look at their dividend, they still have a tremendous dividend yield, right? We're looking at a 5.68% yield, which is still one of the highest in the market. And it's still, despite the cut, one of the companies that many investors still consider a top-notch dividend company, right? So we got a company that is starting off with a yield of 5.6%, a tremendous yield. And then when you consider their payout ratio, that is 47%, a very good payout ratio, one of the lowest out there. Very good sign that they're able to continuously pay that dividend despite what the market may have. So we got a company that has a tremendously good dividend yield to start you off, a very low payout ratio. Now, they did lower their dividend when they spun off Time Warner, so they had to lower it. But to start off, we have a very good company so when they had Time Warner, when they had Warner Media, they were a dividend aristocrat. So they did lose their dividend aristocrat status, but they're still a dividend yield, still a dividend monster, one of the best companies when it comes to dividend. Now, some people may say that Verizon is a better company. Some people out there will say, hey, I'd rather have Verizon than at&t. The reason I picked at&t over Verizon is because of Verizon does have a better yield. They start you off at 6% versus Verizon's 5%. So you get a little bit better of a yield. But when it comes to the overall stock, you can see that Verizon has just been hammered this year. So we got Verizon that has had a very rough year in the last year, where they're down 21%. So they haven't had the best of years, considering when you look at at&t actually been doing pretty all right? at&t is up over 30% in the last year. So you got a company that you're going to get your growth over time, right? And you're going to get a very good dividend, versus another company they have been hit pretty hard. They continuously going lower. You may get a better dividend yield, but they're not doing as well. But I think when it comes to both of those companies, you can't really go wrong per se. I just prefer at&t a little bit better over Verizon. So that's 5 companies that I consider my top dividend yields or top dividend companies for 2023 and beyond. If you guys made it to the end of the video, thank you so much. I really do appreciate it. As a bonus stock I'm going to give you is going to be VOO. Many dividend investors have heard of this company or heard of this stock. It is a ETF that covers the S&P 500, a Vanguard S&P 500 ETF. It is on the expensive side as far as the buy for the stock, but it is one of the most well-known ones, and it covers the S&P 500. A lot of people don't like to invest in individual stocks. They rather have an ETF, and this is one of the most reliable ones out there. Now, when it comes to their dividend, they don't have the highest yield. So we're looking at a dividend yield of 1.6%. But once again, this is a very reliable dividend. And because it is a S&P 500 ETF, it covers the overall stock market. It covers the top 500 companies in the S&P, which a lot of people like to invest in because you don't have as much downturn versus investing in individual stocks usually. So something to keep in mind, guys. This is another company that a lot of people invest in, or a stock that a lot of people invest in and a lot of people follow. And I'm pretty sure a lot of the dividend investor guys out there have covered this stock. So Vanguard, VOO, Vanguard S&P 500 ETF. Once again, guys, I thank you so much for watching this video. It really does help out the channel. If you go ahead and like the video, if you like what you guys heard today, leave any comments. If there's any dividend companies out there that you think are better choices than the ones that I gave, let's have a constructive, positive conversations down there in the comment section. I'm going to be looking at all of them. So please leave any comments that you may have, guys. And once again, we are a new channel. We're trying to grow. So if you can subscribe to the channel, it really helps us out. We are new. I'm trying to get 100 subscribers. So I really appreciate it. If you guys can go ahead and subscribe. Thank you for being here. This is my top 5 dividend stocks. Thank you for being here. I appreciate you. I'll see you next time. Bye-bye.